to the PE1 presentation. My name is Russell Pillemer, and I am the CEO of Pengana Capital Group. With me in today's session, we have Fred Pollock, Jonathan Hirschritt, Corey Lopretti, and Michael Kirshner from Grosvenor Capital. The presentation will last approximately 40 minutes, after which time we'll have plenty of opportunity to ask questions. Without further ado, let me hand over to Fred Pollock from Grosvenor.
Great, thanks very much, Russ. If we turn in the pack just to slide 3, just a reminder what the Private Equity Trust, PE1, is meant to deliver. We invest across a highly diversified global set of private equity portfolio companies. There's about 250 companies across 19 funds today. In terms of performance, you would see the aggregate private markets underlying investment multiple increased by about 50% to 1.34 times. This was really driven by two things. The first is opportunistic investing done through our opportunistic investing strategy, which we'll talk about later on this call. And Mike Kirshner, who's the COO of the Strategic Investments Group, which runs that fund, will be talking about it in great detail, and I'll join him. The second was really performance in our co-investments, which are direct investments alongside market-leading private equity sponsors in portfolio companies, which we'll talk about in more detail, particularly in healthcare and consumer staples. And both John Hirschritt and Corey will be spending some time talking about that as we get to the portfolio update. Overall, for fiscal year April 30, PE1's private market investments contributed about 16.1% of the total NAV return. If you look on the next slide, this is the breakdown of that return. So 16.1% in valuation gains associated with the private equity investments. We'll talk about what that means. It actually required a fairly significant outperformance in a number of the different invested areas because the portfolio is not fully ramped today, and we'll talk about that. The alignment shares, which were contributed as part of the launch of the vehicle, obviously had a gain as well. And then there was a detracting of 9.1% from currency, which was a substantial drag on the local currency return, but we think over any long period of time, obviously, should be relatively neutral on the vehicle. And aligned with, and as you can see here, our perspective early on that would be aligned in terms of when markets were negative and valuations were negative, it would serve as a buffer. And the downside was true last year and this year, that it would drag returns a little bit from the underlying assets when things were good, also turned out to be true. And so we're seeing the stabilizing force of the currency and the trust's overall returns. I want to comment first and spend some time talking about themes in private equity. We'll look at slide 6 just to do this. The first big theme when investing in private equity companies today, deal flow slowed down dramatically in the first half of 2020, but by the second half of 2020 really had recovered to about the same levels that we had seen through 2018 and 2019, such that the year in total ran a little bit lower than the prior year, but not much. And the velocity of deal activity that we're seeing so far in 2021 exceeds that which we saw even in 2018 and 2019. And so, you know, the result of the COVID pandemic largely was to slow activity dramatically in Q1 and Q2 of last year. And then you saw a pickup in activity, and you're actually seeing probably increased activity relative to what you would normally see this year. And so net, when you think about the overall trends in investing in private equity, if anything, it's gone back to normal, and then maybe even served as a catalyst for a continued flow of capital into private equity companies. On the next slide, valuations. Obviously, there's been a large impact in the markets. If you look at March of last year, global markets went down 30 to 40%. In a liquid space, in private equity was far less, less than half of that in terms of the declines associated with the market, which is one of the attractive features that make people want to invest in private equity portfolios. But despite markets having recovered to this point, there are real winners and losers, meaning it's not an even dispersion. I like to think of it all as an acceleration of trends that were already in place. That's really what we've seen, and that's the lasting phenomenon that we're seeing in the markets. And if you look on the graphic on the top left of this page, we try and identify some of what we observe as COVID winners and losers so far. So things like enterprise software, SaaS platforms, digital companies, healthcare, all big winners. The losers, obviously, through COVID, travel, hospitality, retail, and restaurants. Those are places, though, that I think you would expect as 2021 and 2022 unfold, and you start to see a normalization in certain key markets, such as the United States and Europe. You should see a significant recovery in those areas. And so we do have some investing going on now, but sort of investing ahead what we see as the next real trend. Inside the trust, and we'll talk about this later, one of the big drivers of value last year was the opportunistic allocation. We were able to invest in private companies that were dislocated in March and April of last year. We were also able to invest in a number of sectors that we saw as long-term COVID beneficiaries at reduced prices during that period that then drove return later in the year, which we'll talk about in more detail in a second. Quickly, just talking about capital markets. So on slide 8, we get asked a lot what exactly is going on in the credit markets. The credit markets have never been looser for sponsors looking to finance private equity transactions. It is both cheap and without covenants typically, meaning the amount of leverage, the cost of that leverage, and the terms of that leverage are extremely favorable for private equity sponsors trying to do deals. The real key, though, is that people not allow that leverage to lead them to overpay for companies. And so if you go to the next slide, slide 9, one of the things that we monitor very carefully, and we're happy to take some questions in the Q&A if this comes up, but is the average entry multiples and making sure that companies that are being bought are not being bought at prices which are giving away the advantages associated with the finance that you saw previously, or that are at excessive valuations just because markets are frothy in certain pockets across the globe. And so you'll see on this graphic, there's a lot here. You'll see that the buyout multiples haven't really changed all that much over this period of time. They've actually been pretty stable in private equity. The other thing that you'll see is that the middle market space where we heavily traffic is always traded at a discount to the large end of the market in terms of overall multiples on companies. We continue to see that in 2021 as well. And so we feel good about where we're placed. The next slide, one final comment on themes of private equity before I turn it over to the rest of our team to go through a little bit more in terms of the portfolio specifics. PE secondaries. So as you go through the portfolio, and John Hirschred and Corey will spend some time talking about it, one thing that you'll notice is the one area that was affected in terms of pace of deployment, volume of deployment in 2020 was the secondary market. And so LP-driven flow, and really what LP, meaning limited partner-driven flow, means the sales of existing private equity funds to people like Grosvenor to add into portfolios. The volume of those sales of existing funds dropped in 2020, but hasn't quite rebounded yet. And so that's something that we expect as part of our planning to increase the pace of deployment and catch up, so to speak, on what we were expecting for deployment in 2020 to happen in 2021 and 2022. There's a lot of reasons for that, and we'll talk about it in greater detail later on during the Q&A. But the major ones is it was just people who owned these existing private equity portfolios didn't want to realize them at low valuations in Q1 and Q2 and Q3 of last year. And so they've been waiting for a rebound in those valuations alongside of what you've seen in the rest of the markets. As that rebound has come through, people are starting to monetize their interest in some of those portfolios. And so we look to selectively be part of that flow at the appropriate times and the appropriate price levels. With that, I'd like to turn it over to John Hirschred to start going through the portfolio itself and talking about some of the deployment activity. John?
Thanks so much, Fred. On slide 12, what you'll notice is when we first launched this vehicle, we had said that it would take us roughly 4 years to get fully ramped up to our target private equity allocation. Private equity, generally, you want to invest throughout the cycle. You don't want to pick a specific point in time. And as you'll see, it takes time for the commitments that we make to be drawn and invested. And so if you look at the bar on the left, this is where we are as of the end of April. And the bar on the right shows that when we first launched the IPO and the prospectus, where we thought we would be. We knew at the time that we wouldn't be able to predict exactly what returns would be and how quickly or slowly capital would be drawn in the different implementation styles. But we closely monitor and manage this so that as a whole, we're getting good diversified private equity that can deliver through the cycle returns. And what you'll see is that we feel that today we're broadly in line with where we thought we would be from an estimates perspective, and still feel very comfortable with our target of 4 years from the original IPO. You will notice that the blue bars, the shades, are a little bit different than what we may have expected. As Fred called out and Mike will speak about later, the opportunistic sleeve has been the fastest to invest the capital and has also had very outsized gains. And so that has led to that being a larger bar. And then what you'll notice is that we always knew primaries would be slower to kind of draw capital because those managers generally take about 3 to 5 years to find the deals in their funds. And then the co-investments I'll talk about a little bit on the next slide, but they're actually more invested than it might appear on this slide. And the secondaries, we feel good that we're starting to ramp up there, even though we've talked about in previous webinars that it's been a little bit harder to find due to some of the volume challenges around COVID that Fred spoke to. If we go to slide 13, what you'll notice is that in each of our main verticals, whether it's our co-investments, our primaries, our secondaries, or our opportunistic, across the whole vehicle, we're about 74% committed in regards to the capital, and would expect in the next kind of 6 months for that to go up close to almost fully invested. We have a handful of vehicles that are coming up that we can see and we're planning for, and we would expect that to ramp pretty quickly. The actual funding or the investments of those commitments will take a little bit longer. Today, as you can see on this slide, it says that we're 55% invested. In reality, today, in May presently, we're actually closer to 65% invested. And the reason why is if we look at the first bar, for instance, we invest through a co-investment fund where Grosvenor bundles a handful of co-investment deals, which Corey will talk about. What it appears here is that we made a 48 million Aussie commitment to this fund. 22 million is unfunded and 26 million is funded. In reality, about 82% of that vehicle is actually funded, but is using a subscription line that's going to be taken away in the next kind of 3 to 6 months. And so what that does is that means that the actual amount invested is actually higher than it appears here because the subscription line doesn't reflect capital called from PE1. On the primary side, again, that's a slower kind of ramp. We're starting to see some of our funds draw that capital, which we're excited about, but we always expected to need to commit more up front and then let that kind of draw over time. Secondaries, again, it's a real opportunistic strategy in the sense that it's really dependent on quality deal flow and you can't time it. You need kind of willing sellers in the market at attractive deals and prices. The good news there is that here it looks like 6 million is funded out of 35 million committed. The good news is that as of this month, we just recently made another $5 million investment drawn from our Grosvenor Secondaries Fund 3, which is our recent commitment. And then we have another small deal. So we've almost doubled that to about 12 million Aussie that's been funded in just the last month. And would expect that to continue to ramp and would also expect to commit more capital over time to the Grosvenor Secondaries Fund. And then lastly, Mike's going to talk a lot about the opportunistic sleeve, but this is fully invested at this point, 74 million Aussie. That does include, we have significant gains as well in there, but it is fully funded and we would expect the next vehicle there to begin to launch in the next 6 months. So with that, maybe I'll hand it over to Corey and he can get into some details around some of the more recent investments in the portfolio.
Thanks, John. Good morning, everybody. So it has now been about 2 years since the launch of PE1, and we are already well diversified, having committed 216 million to a mix of PE primary funds, PE co-investments, PE secondaries, and opportunistic investments. As John just noted, we're nearly 75% committed to date, and the portfolio already has exposure to over 250 underlying companies. As you can see on slide 14, you can see our entire portfolio. And within our PE primary sleeve, we have made commitments of 59 million to 10 primary private equity funds. This includes 8 oversubscribed, difficult to access middle market buyout funds and 2 special situations funds. The Carlyle Credit Opportunities Fund, which is a private credit focused fund, and Peak Rock Capital Fund 3, which is a distressed debt focused fund and our most recent primary commitment. Peak Rock actually seeks to invest in businesses that have leading market positions, but that are underperforming due to identifiable issues, such as strategic and or operational errors, over-levered balance sheets, or weak management teams. Peak Rock is quite good at identifying and addressing these types of issues and ultimately selling stronger companies than they purchased. So we're quite excited about that fund being in this portfolio. Within our PE primaries allocation more broadly, we have generally targeted disciplined sector specialists that possess unique sourcing and operational capabilities to drive value, and importantly, have demonstrated those capabilities over multiple market cycles, as those are the types of managers that have proven to be the most successful no matter where we are in the market cycle. The middle market buyout managers PE1 has invested with are all historic upper quartile performers, and in nearly all cases, we at Grosvenor have been investing with them for many years and in many of their funds. For example, Veritas 7 is the 6th Veritas fund we have invested in, and we have committed over $835 million to those funds on behalf of our clients over the years. We believe the managers in the PE primary sleeve, are very well positioned to take advantage of new opportunities, with around 75% of their capital still to deploy to new investments. And there has been a marked ramp up in activity over the course of the last 3 to 6 months. In terms of underlying investment exposures, the primary fund that is called the most substantial capital to date is Carlyle, which has now committed over 100% of investor commitments to 31 deals. This includes 6 new deals executed in Q4 of 2020. That portfolio is doing well with strong liquidity and only 4 companies having exposure to COVID-19 related impacts. 3 of them were travel and leisure exposure, 1 had airline exposure, and 2 were a tourist attraction and a hotel. And then 1 had supply chain impacts due to the fact that its headquarters was in Northern Italy. Carlyle weathered the storm back in March of 2020 quite well for a credit-focused fund, with a markdown of only 7% in its portfolio. And between Q1 and Q4 of last year, it saw its portfolio appreciate by around 10%. The markups quarter over quarter were driven by a number of factors, including a rebound in the public credit markets, positive developments across several key investments, and a number of full and partial realizations within the portfolio. Overall, the gross multiple of that fund has increased 13 to 15% since it bottomed out as of 3/31, and it's now marked above where it was at the end of 2019, despite the fact that performance reflects 6 new deals executed in Q4 of 2020, all of which are held at or slightly above cost. The portfolio has also had a healthy cash yield of nearly 8% since inception. Another one of the funds that has had some real deployment is Riverside Microcap, who's deployed around 43% of its commitments to 9 platform investments, as well as a number of add-on acquisitions. All of the companies in that portfolio are marked at or above cost on a gross basis, including one company, Modern Hire, which is a company that provides online pre-employment assessments and digital interviewing software for a number of different companies, companies like Amazon, Walmart, and CVS. The company is marked at a 1.6x gross multiple, really buoyed by the remote working environment that was accelerated by the pandemic. And then the last PE primary fund I'll talk about is Veritas, which I mentioned earlier in terms of our commitment to them over the years. They had a very cautious start to their investment period, and they have really ramped up their investment activity starting in late Q3, early Q4 of last year. They completed their first transaction back at the end of Q3, where they financed the carve out of a US state and local health and human services business from its New York Stock Exchange listed parent. That company, it's called Gainwell Technologies, provides technology solutions that are essential to the administration and operations of health programs throughout the United States. The company serves a majority of the US states, and its solutions impact approximately 2/3 of the Medicaid beneficiaries across the United States. This investment is squarely in Veritas's wheelhouse. It's a company that provides critical services to the government in the healthcare space, which are 2 sectors where Veritas has demonstrated significant expertise over the years. Turning to the co-investment sleeve, PE1's allocation to co-investments is currently being executed through a commitment to GCM Grosvenor Co-Investment Opportunities Fund 2, or GCF2. Just as a reminder, GCF2 targets co-investments alongside high-quality middle-market buyout managers in companies that have established revenue models, preferably in defensive sectors such as healthcare and consumer staples. PE1 has a $48 million commitment to GCF2. To date, GCF2 has committed over $630 million to 22 companies, and Around 560 million of those commitments have been invested. The portfolio is very well diversified by industry, geography, vintage year, and sponsor, thereby providing really good downside risk mitigation. The portfolio also includes 7 new co-investments made since October 1st, and we are currently doing diligence on several deals, one of which will likely be the final investment in the portfolio. GCF2 has weathered the COVID storm well. It saw its gross multiple recover to a 1.31x as of 12/31, which is above where it was marked at the end of 2019. And it's worth noting that this includes 8 new investments GCF2 made in 2020, many of which are being held at or around cost. If you exclude those investments, the gross multiple for the other investments in the portfolio rises to a 1.46x. So we're pretty happy with how performance has gone thus far. The performance also represents a more than 30% increase in the gross multiple from where it was back in March when the pandemic began shutting things down across the US and Europe. I think it's also important to note we do not currently view any of the investments in the portfolio as potentially high risk due to the impact of COVID-19. This is due in part to the more defensive nature our co-investments have taken in recent years. Investments in companies like Spice World, which supplies fresh and processed garlic to grocery and club stores in the US. Codabiti, a provider of payment accuracy solutions focused on the healthcare industry, and Inofis, a global producer of phosphate and non-phosphate ingredients that are used in food and health, nutrition, and industrial end markets. All of those companies are positioned to perform well no matter where we are in the economic cycle. Now, it doesn't mean there wasn't any impact on our portfolio as a result of COVID, and there are still a couple of companies that we view as medium risk from a COVID perspective. One such company is Unifrax, which produces specialty fibers that are used within the emissions control and fire protection industries. Our initial medium risk assessment last spring was due to the temporary shutdown of a plant in China. Revenue was down 25 to 30% in the March-April time period, but performance has been steadily improving month over month, with Q3 2020 revenue and EBITDA increasing substantially over the prior quarter. Additionally, for that company, demand for some products like filtration has been increasing, and the company's new product pipeline includes a number of green initiatives. Our original investment thesis remains the same, and if anything, we actually believe there may be some nice upside as a result of increased demand for some of their new products. And I believe I talked about this in our last webinar, one of the positive post-March crash stories in the portfolio is Vera Mobility. They were a major provider of toll management solutions to rental car companies in North America. And when we last had our webinar last spring, we talked about with travel grinding to a halt, the car rental industry was obviously hit hard, and we had some real concern about this company. The stock bottomed out in mid-March at around $6 a share, but the company's shares have increased over 100% in value to just over $14 a share at the end of trading today, and are valued at over 85% more than what GCF paid for them overall. And then turning really briefly to a couple of our newest investments. One of the fund's most recent investments was a $39 million investment in Nestle Waters North America, alongside one of our premier emerging managers, One Rock Capital Partners. Nestle Waters is one of the leading providers of bottled water in North America. Their products are sold in nearly all retail outlets across the US. They hold 8 highly recognizable brands sold through the retail and home and office delivery channels. This includes Poland Springs, Arrowhead, and Nestle Pure Life. We liked the fact that Nestle Waters operates in a consumer staples business that has favorable market trends and that they have a wide array of well-known products. We also believe that there's a great opportunity for One Rock to go in and make meaningful operational improvements that have the potential to significantly increase the value of the company prior to sale. And then we also just completed a $26 million investment in Mavis Tire Express, one of the leading independent tire dealers in the US. And then finally on GCF, there's been some real meaningful realization activity within the portfolio, with BDP International, a logistics solution provider for the chemical and industrial channels. They've returned approximately 30% of our investment costs. And then Inofis, the phosphate company I mentioned before, they returned over 40% of our investment costs earlier this year. I'll skip over the opportunistic bucket as I won't want to steal Mike's thunder, and I'll talk about secondaries before turning it over to Mike. So in secondaries, we're really finally seeing a nice uptick in activity after a very slow 2020 that was driven by the significant decline in LP sales last year. At the end of 2020, PE1 committed $25 million to our secondary opportunities fund, GSF3, which will provide investors with a single point of entry to a diversified portfolio of secondary opportunities. GSF3 will invest in traditional LP secondary interests as well as GP-led transactions, and will seek to create a portfolio of 15 to 30 investments. The fund will focus on more mature secondary opportunities, targeting transactions where more than 50% of the acquired capital commitment is drawn by the underlying fund manager at the time of the transaction closing. The fund has already closed on 2 investments, and has 2 more investments that it is completing due diligence on and are likely to close in the next month or so. Outside of GSF3, PE1 also closed on a approximately $3 million private equity secondary transaction at the end of March. We called it Project La Pinta. As part of La Pinta, PE1 acquired interest in a portfolio consisting of 11 underlying fund interests with vintages from 2008 to 2017, along with 2 direct company investments, all assembled and managed by Mubadala Capital. The portfolio includes 3 Carlyle funds, 3 funds managed by Rain Partners, and 2 funds managed by BDT Capital Partners, so a mix of buyout and growth managers. The transaction also included a commitment to a seeded portfolio being raised by Mubadala that is currently approximately 60% funded with 6 existing investments. The combined portfolio is well diversified across over 100 underlying companies, with the largest single company exposure representing approximately 8% of overall NAV. The portfolio is priced with a 10% discount to September 30 NAV, which, based on subsequent movements in underlying company valuations before the closing, ultimately represented a 22% discount to NAV at close. The transaction also included a purchase price deferral, with 50% of the purchase price being paid up front and the remainder being paid in 15 months, as well as a number of potential near-term realizations, which should help enhance returns. And then finally, PE1 also just closed a $5.2 million secondary transaction in Evolution Partners 5. This is a newly created vehicle managed by a firm called Cobalt Capital that will acquire 7 assets that Cobalt had been previously managing on behalf of TPG Growth Partners. The portfolio is priced with a 6.3% discount to 12/31 NAV, which is actually estimated to represent a 37% discount at close based on write-ups associated with the most recent financing round for 2 of the assets in Evolution 5. The portfolio includes a number of well-known consumer technology and media companies, including Epic, which is a digital reading platform for kids 12 and under, The Athletic, Masterclass, as well as Calm, the award-winning mindfulness app. So lots of stuff going on in the portfolio, with most of the activity really being quite positive. Let me turn it over to my colleague, Mike Kirchner, who will talk about the opportunistic sleeve of the portfolio in some greater detail.
Thanks, Corey. Nice to speak with everyone. I'm Mike Kirchner, and I'm the COO of the Strategic Investments Group at Grosvenor. And it's our group that manages the opportunistic strategy within the Pengana portfolio. So I thought I'd give you an overview of what the opportunistic strategy is, and then we can go into some detail on the investments, which have performed very well thus far. So when we say opportunistic, what we're really talking about is a strategy that has the flexibility to source illiquid investments from across the Grosvenor platform. Oftentimes, we're focused on opportunities that are unique. Maybe they don't look exactly like traditional private equity deals. So these could include growth equity transactions or structured situations that have loss mitigation features to protect our downside. Essentially, I would think about it as unique deals that are difficult to source, but they have very favorable risk-return attributes. So as I mentioned, the opportunistic strategy is managed by the Strategic Investments Group. And on the slide here, we outline what we really think are our competitive advantages in the marketplace. First and foremost is the platform, and I'll elaborate on that in a minute. But we basically leverage the broader Grosvenor platform to source co-investment deal flow from elite managers. And then we pair that sourcing engine with a very experienced investment team and an operational capability that allows us to seamlessly and quickly execute on deals that become available in the marketplace. As a result of these advantages on the slide here, we've really established ourselves as the preferred co-investment partner amongst many of the elite managers in the marketplace. On the next slide, I wanted to spend a minute on the platform because it really is the key competitive advantage in our opportunistic strategy. So there really are few firms in the world that have $62 billion invested exclusively in alternatives. So private equity, infrastructure, real estate, absolute return strategies, and credit. And that's $62 billion invested with over 600 underlying investment managers. The reason that's important is that when you have a platform like that, you just have an immense amount of deal flow. So Even if you had each of your investment managers just bringing you 1 or 2 interesting transactions a year, you're easily going to see over 1,000 opportunities from which to choose from. And that's really our task in the strategic investments group. It's to filter that deal flow, perform due diligence, and execute only on the few transactions that meet our very high standards. As part of that process, on the next slide, I wanted to just touch on data analytics and just how important data science is becoming in the investment industry, and in particular, our strategy. So it's not just all the deal flow that comes through the Grosvenor platform. We get a ton of information flow. And we've spent a lot of time and resource over the past 6 years to really harness this information flow in a way that can be valuable to our portfolio and to our returns. This included building a proprietary database. So we have a repository for all the information flow coming through the firm, and then using financial technology to be able to search through that information flow in an efficient way. And essentially what this does is it expedites our diligence process and really helps us focus our research on only the most compelling opportunities ex ante coming off the platform. This is how we get from 1,000 ideas down to a couple hundred that we're going to roll our sleeves up and do the diligence on, to finally get to the 20 or 30 that would make it into our portfolio in a given year. On the next slide, all of this activity, the outcome, it goes into the multi-asset class funds, and those are the flagship funds for our strategy. MAC2 is the current vintage. This is the fund that is in the Pengana portfolio. In these funds, we generally target a mid to high teens net IRR over their life, and a net multiple of invested capital of about 1.8 to 2 times. They have about a 3-year investment period and a 5-year harvest period, so an 8-year total term. In MAC2, a 2018 vintage, it's almost exactly 3 years old. It was about $1 billion fund. It's going to be an exceptional vintage. Already only 3 years into its 8-year life, a 44.1% net IRR, and has already achieved, it's fully called, fully deployed. So on that entire capital base has already achieved a 1.63 net multiple. So I think we're confident in saying, given how fast the start has been in MAC2, that it should exceed its performance targets at full maturity over the next 5 years. We're commonly asked, what's driving the exceptional performance in the MAC funds? There's a couple, I think, high-level themes within the portfolio. And I think Fred, who again is the portfolio manager of the MAC funds, is going to run through those themes and some of the examples specifically.
Thanks very much, Mike. So if we go to slide 21, the next slide, just briefly, if you look at the pie chart on the left-hand side of this page, what'll become evident first, overweight information technology, consumer discretionary, and healthcare. And that was quite deliberate. So a lot of what we talked about in terms of the themes that you saw coming through COVID and what was the beneficiary of those themes. And you see it on the top left of the box on the right, are we call accelerated secular trends. And so we deliberately deployed capital and additional capital into things like Instacart, Stripe, which is a payments processing company, and firms like that benefited substantially from what you saw during COVID. That was done at exceptionally good prices in March, April, May, June of last year as the market dislocated. The second thing, just pure tactical positioning. So the opportunistic strategy operates the way its name sounds, meaning it can draw capital and deploy it very, very rapidly, depending upon where value is available. And so there's a couple examples you'll see on the top right of this graphic: Carvana, Crown, and MasterCard. The Crown in this particular case, not to be confused with the Crown that you would know in Australia. This Crown is the beverage can maker, largest beverage can maker globally in the world, where you saw a dislocation in kind of activity and volumes. We were able to take advantage of it mid last year. On the bottom 2 boxes, you'll see that we make kind of a steady amount of investments in the defensive industries and in healthcare. And in both of these areas, we have very consistently, regardless of whether the market is doing well or doing poorly, been able to invest in those areas and generate real alpha and return for our clients and for this portfolio by doing that. And so, on the bottom left, you'll see things like Pathway and Lineage. Those are both actually roll-ups. What that means in private equity is that the private equity sponsor is working hard to go through that industry, gather capital, invest that capital, and buy smaller companies in the same space. And so Pathway Vet Alliance owns almost 1,000 vet clinics where they have acquired them over time and continue to roll up that industry. The second, Lineage, is the largest cold storage business in the United States and now in the globe, which means they own assets which are distribution centers for food in the grocery chain. So frozen food in the grocery chain. Obviously facilitates what you'll see in the top left, which is Instacart, and I'll talk about that one in a second, which is online grocery delivery. And so we got to one of these investments through the other in terms of following a trend and realizing that there was profits available for us in that space. Healthcare on the bottom right, a couple of different names. I won't go through them in great detail, but we have been able to mine our platform to produce a significant amount of alpha in each of these, as well as other healthcare names. The one thing to note here is that you do it in a highly diversified fashion to be successful. And so you'll see a lot of names, even though it represents sort of 9% of the portfolio or so on a gross exposure basis. That's because we don't want any one of them to be outsized in terms of its risk contribution. If you go to the next slide, maybe I'll just call up one example just to give a sense of how this works. So I'll use Instacart as my example. For those of you who are familiar with online grocery delivery in the United States, Instacart is the leading market participant in that space. And so there are really three players. There's Instacart, which was founded by an individual who left Amazon and who had been running their grocery strategy and decided to create an independent company that could partner with existing grocery stores to deliver groceries online. You obviously have Amazon, and then you have Walmart. When we made this investment in late 2018, our thesis really was that we were buying into the company at an incredibly attractive valuation, that it was going to grow over time from just the growth and the penetration of online grocery ticking up quite regularly, and that we were backing the best management team in the industry writ large. We did this alongside D1 Capital Partners, which is a globally leading investor in public and private technology companies. So they kind of bar none is probably the best crossover investor, meaning they invest in companies that are expected to be private for a few years and then go public, and you exit into the public markets. They are a preeminent player in that space. We were able to partner with them, make an investment where we as Grosvenor as a firm invested about $200 million alongside their $400 million back in October of 2018. We were able to add to our investment in March of last year at the same price, which is phenomenal. So obviously the company was being benefited by COVID, but the market was in distress in March, and we were able to buy some additional shares from someone who was a distressed seller during that period of time, which helped enhance our return. The company, when we invested, the total enterprise value of that company was $6 to $7 billion, depending upon which of those two different times we invested. Today, the company is valued at north of $30 billion and is expected to enter the public markets later this year at a valuation significantly in excess of that. So we will have generated real multiple as well as a significant IRR on that transaction. So hopefully this one highlights a couple different things about the way we like to invest. One, we like to invest alongside the absolute best sponsors globally. D1 Capital Partners is exceptional. What they're doing is exceptional, and our ability to invest alongside of them is a real benefit to ourselves and to our clients and our investors. The second thing, which I think is notable, we do choose our spots. And so, this was the largest investment in the Opportunistic fund. It was done at a unique period in time before, I would argue, before most investors had become aware of the online grocery space and the movement to online grocery at that time. It significantly benefited from accelerated trends throughout COVID, and we were able to deploy even more capital into it at that time. And it's going to go public. And this is a great example of where investing in a private company or investing in private equity companies during that phase of development can lead to truly outsized returns when they enter the public markets, and then we're able to exit those investments and recycle the capital for the benefit of the trust into other private companies in the future. There's a few other examples in this deck. I'm not going to go through them all because I want to leave time for questions. But with that, maybe I'll pause and turn it back over to Russ to begin taking questions.
Thank you, Fred. That is really appreciated. Great insights from everybody at Grosvenor. Moving on to some questions, and please, if anybody wants to add additional questions, please submit them on the screen. So let's kick off with this question, Fred. There's a lot of talk, obviously, about elevated prices in the marketplace at the moment. But there's also talk about potential rising of interest rates over the coming months or years. How are you factoring this into your evaluation of companies, and what impact might this all have on PE1 going forward?
Great, thanks, Russ. So, I mean, there's a couple of things in that question which I think are all important. So the first, the questioner is asking, do we see elevated asset prices? And the answer is yes. So if you looked across the board, both in the public market context, certainly in the credit markets, and to a lesser extent, although still present in some of the areas of private equity, there's no question that asset values have fully recovered from the pandemic. And in some cases, have even exceeded the valuations on the multiples that they traded at pre-pandemic. And there's a lot of reasons for that. There's a significant amount of liquidity in the marketplace. Central banks are still highly interventionist at this point in time. Interest rates are being held very low from a policy perspective. At the same time, there's a lot of fiscal stimulus entering the economy and improving people's expectations about performance of the underlying companies. And so, some of that's justified, some of it's a market condition, but it's something to be aware of. So far, what we've tried to do is really take advantage of it. And by that, I mean, where we have sponsors and portfolio companies that can take advantage of relatively low leverage and loose terms, we definitely are doing that. In places where we have acquired assets over the last year or two as the trust has been operational, where those values, our perception of them in the public markets in particular, they might be well received and trade at multiples that we would not be willing to pay in the private markets. We are, part of a process of encouraging alongside our sponsors, those companies to enter the public markets, and so that we can dispose of those assets and then move the capital to other spaces. And so I guess probably my long-winded answer would be we're very, very aware of those things. We're trying to take advantage of them where we can, and just trying to avoid mistakes by not entering or participating in the frothier parts of the market. As you probably saw in one of the earlier slides as I went through it, the multiples in the spaces in which we heavily traffic, which are defensive areas in the middle market buyout space, those have been pretty stable even through this period of time. And so at least so far, we're happy that the markets that we traffic heavily haven't been as affected as some of the more liquid markets where obviously central bank intervention is directly having an impact.
Thank you, Fred. Next question. In a recent communication, you mentioned that you were considering putting money back into short duration credit. What is your thinking on that topic now?
Sure. So maybe I'll take this one, and then I'll ask John Herscher to comment as well, because he was part of this. So I think we're still considering it. When we took the capital out of the short duration credit, it was because the market was dislocating, last March. And I think that was the correct decision at the time. It helped us preserve capital, and we were attempting to generate relatively low rates of return in a low risk fashion with those investments. And so we didn't want to take any risk of principal loss, at that time. And we had generated decent profits at that moment. In terms of re-entering, I think there's kind of two concerns. One, we'd like to earn a rate of return on that capital, but we also don't want to take any risk. And high yield spreads are as tight as they've ever been. kind of in 2-decade low levels of spread available, and investment grade credit's not much better in terms of the spread and levels of spread. And so part of what we're trying to work through, and we're doing it in real time, and part of our consideration is it worth it? Are we getting paid enough risk adjusted return for that trade-off? Or can we just accelerate the deployment of our capital? And part of what's prevented us so far, so to speak, from deploying that capital in short duration credit is that the opportunity set we're seeing in opportunistic and co-investments, what we're starting to see in terms of the pickup of activity in secondaries, is making us believe we really don't need a place to park the capital. We think that our accelerated deployment elsewhere in the portfolio is going to use that capital in a relatively near-term basis, and therefore it's not going to be needed to generate a return over the next couple of years in the short duration credit. But if that flow slows down or we fail to execute on some of those transactions, then we'll reassess at that time. But we always keep it under active consideration.
Thanks, Fred. Next question is about hedging and the A dollar. So US dollar performance has been very strong, but the rise in the Aussie dollar has meant that returns are much lower. Have we considered hedging the portfolio? I'll actually take this question. So from the perspective of Pengana, we promised our investors when we went into when we launched PE1 that this would be an unhedged portfolio. We continue to believe that that is the best way to manage the portfolio. It does take a lot of the volatility out of the portfolio. Now, over time, we believe that the currency won't make a huge impact on returns. There are very strong returns from the underlying portfolio. The Aussie dollar comes and goes, as we know, and we believe that there is sufficient gains in the portfolio to be able to deal with any negativity that might come from the rising Aussie dollar over the long term, and that will still continue to provide very strong returns to investors. And so there's no intention to change that strategy. Investors should consider this as part of their US dollar exposure in their diversified portfolios. Next question. Has the 22% uptick from the discount in the Move dollar secondary transaction already been reflected in the PE1 NAV?
Maybe for that one, I'd ask Corey if you wouldn't mind taking it.
Yeah, no problem at all. No, not yet. Usually when a secondary transaction closes, we have to wait till we receive our first PCAP from the investment vehicle that we invest into. And when you get that PCAP, does your limited partner capital account statement, you will get that discount will be reflected as the portfolio is marked back up from where we purchased it at.
And a similar question just on valuations is about the Instacart transaction. And that is, how do you think of the Instacart potential exit price on a RPO relative to the most recent valuations used in the portfolio?
Maybe I'll take this one. So obviously there's no knowing until a company goes public, and then it has to sustain that price for a period of time before you can exit and realize into that process. Public comparables at this point in time trade far in excess of the valuation at which Instacart is held. And the information that we would have about the process and what we think is likely to happen there would suggest that it should be a favorable evolution in the value if it were to go public today. Obviously, that is market condition dependent. So, if something bad happens in the public markets, that could obviously take more time or could affect value in the same way it would affect the comps that are out there now. But I think there's a very favorable setup for future value evolution of Instacart as it goes through that process.
Thank you, Fred. Next question. This is about SPACs. So there's been a lot of discussion about SPACs, special purpose acquisition companies in the marketplace, about what that's doing to valuations. What are the implications of PE1 for what's happening in the SPAC market?
Maybe I'll take this one. So I think it's complex. So on one hand, SPACs service competition. And so, if a private equity firm is looking to acquire a company, today that company is very likely to receive an offer from a SPAC at the same time that they're receiving offers from the private equity company themselves. Typically, especially the kind of companies that we're interested in investing in and the types of profiles where we're interested, those are still going to private equity firms. And the types of firms that are going public through SPACs, not entirely, but largely have a different profile. And recently that profile has been companies that are in many cases pre-cash flow or even pre-profitability and pre-revenue. And so you're seeing a real bifurcation in the market where there are exceptions to this, but there are not an enormous number of very stable private equity companies in the middle market space that are pursuing public listing via SPAC. There was a reason they were held privately. And also the private equity sponsors are often adding significant value to those companies. The larger SPAC transactions that people are seeing are almost all kind of comparable transactions or competitive transactions to just going public through either a traditional IPO or a direct listing. And so that's the type of transaction that we're seeing. And on the other side, there are private equity held companies that have grown in size to the point where they're deciding whether to take them public, either through those two channels. And so therefore SPACs are becoming a potential exit opportunity for them. So it's a little bit of a mixed bag. It's a little bit of competition, but not that much in the area. And then for the larger portfolio holdings, it's just another avenue for potential monetization. I would say the SPAC market has really cooled in the last quarter or two. And you're not going to see as many SPACs launched or as many SPAC transactions that you saw last year. I think that phenomenon, while not going away, is not going to grow in the same way that it has been growing over the last 6 to 12 months.
Thanks, Fred. Next question. When do you expect the portfolio to be fully invested? And once it is fully invested, what sorts of returns should investors be able to expect?
Yeah, maybe I'll throw this one to me. John Hershford, you could talk about the pacing that we've got kind of built into our model, and then the returns we're expecting from each of the segments.
Sure. So when we put together PE1, we looked back at our history. As you can imagine, in all of these different sub-implementation verticals, we have a long history of investing. And so we used both the speed of capital deployment as well as distributions and return assumptions that we had achieved with some conservatism to estimate what we thought were comfortable returns for PE1. What you will see is that once we're fully ramped, we are confident or hopeful that we can deliver net returns in the double digits, the low double digits. Right now, our returns on a constant currency basis are starting to really ramp up. But as Fred called out earlier, currency has obviously been weighing on it significantly. And the amount of kind of uninvested cash for the capital call commitments have also, been weighing on us getting to that longer term return threshold. So we feel good as we kind of enter this next phase where we're getting much closer to being fully invested, that we're going to be able to start delivering those types of returns on a constant currency basis. And then as Russ said, hopefully the currency will kind of calm down. But we did, want to stick to what we promised everyone from the start, that this would be an unhedged vehicle. In regards to the different sub-verticals, I would point everyone to the original prospectus because those numbers really haven't changed. And what you will see is that while there is some differentiation in returns between some of the sub-verticals, generally you will see that they all fall in line with, getting you to that kind of gross, mid double digit to high double digit type of return threshold, and then net of fees down to that kind of low double digit return. Corey, I don't know if there's anything you want to add to that.
No, I think that covered it, John. I guess one other point is, and as we had noted throughout, we still do expect that within, we had said 3 to 4 years from the IPO was when we would hit sort of our targets, where we're sort of equally split between private equity co's, secondaries, the opportunistic bucket, and primaries. And we still think we're going to hit that those targets pretty easily. We always knew the portfolio mix would vary based on performance in any one of the verticals. So for right now, the opportunistic sleeve is because the performance has been so outsized, it looks a little bit more outsized. But over time, that will all even itself back out, and we should be there by year 4.
Yeah, the only other thing I would just end with is that each of the different implementation styles serves a real purpose. And so return is obviously one component, but having kind of diversification across vintage, geography, they all serve different purposes. So if you look at a primaries fund, that's going to have a different, maybe lower return perspective, but we're getting a lot of diversification there because a single fund is typically investing in 10 or more underlying companies, whereas a co-investment is an investment in a single deal where we are not paying, that same layer of double fee. And what that does is it produces a higher target return, but it also increases the risk profile of the portfolio. And so as you go through each one, secondaries and opportunistic, they all kind of serve a purpose within a diversified portfolio. And this is what we do every day at Grosvenor for our institutional clients.
Right. Next question. We've had quite a few questions about some of the exposures in the portfolio. I'll read one of them and then ask you to comment. So there was a recent commentary that the company Stripe is now the most valuable startup in the world. I noticed that this is mentioned as a holding in the PE1 portfolio. Is that company also likely to IPO? And we've got similar questions about SpaceX. So maybe you can just talk about those two companies.
Sure. Maybe I'll take that one. So we have any number of what I'll call crossover investments, which are private equity investments in a growth phase that are being prepared for eventual exit into the public markets. So Stripe and SpaceX fit that mold very well. And the reason being their scale. So Stripe, we invested in some time ago. We've experienced kind of growth in the multiples of value that we invested. It will eventually go public. I would tell you it's the one that the timing of that is a little bit uncertain. The Collisons, who are the brothers who founded Stripe, are not in any hurry really to go public, but over the next couple of years, they're likely to do so. What that means, though, obviously depends on the frame of the company. They don't need to raise capital, and so it's more likely to be a direct listing than probably a traditional IPO where you would raise incremental capital for the company. SpaceX is a little different. So SpaceX obviously is in a high growth phase as they launch a system of low orbit satellites to provide communication services, as well as they continue to perfect their launch business in partnership with certain clients, particularly NASA. That company continues to raise capital in the private markets. It's been going phenomenally well. I would be willing to bet that within a year or two, it's probably the one of the more valued private companies globally, and they will also start turning their minds to going public. Each of those is kind of on a somewhere between a 1 and 3 year pathway to going to the public markets for no other reason than they'll need to provide liquidity to some of their early investors. They don't really need the capital, except in the case of SpaceX, but they're able to pursue that in private form. It would really be a convenience function for the public market process.
Thanks, Fred. Unfortunately, we've run out of time. There's a lot of more questions that haven't been answered. We will certainly get back to everyone with answers to their questions. Please feel free to email us with any additional questions that you might have. Always happy to communicate with our investors and to answer any questions that you might have. Gentlemen, thank you very much for your contributions today, Fred, Jonathan, Corey, and Michael. And thank you to all our investors and prospective investors who have come onto the call. We appreciate the time that you've given us today. Hope to catch up with you real time in the not too distant future. Thank you, everyone.